everyone, welcome back to the Daily Gold Podcast. Today we're speaking with Dave Skarica of AddictedToProfits.net. Dave, it's been a couple weeks since we've done a podcast, so I think it's a good time to catch up with you. A couple things I want to talk about today. First, let's talk about the gold stocks, the HUI or the GDX, whichever one you people out there follow. A couple of months ago, Dave, it looked like these gold stocks had bottomed. They were just about to make a huge breakout. Nope, we have a little mini crisis. The gold stocks come down. They hold support, and then in the last couple of days, they retested that bottom very successfully. I was saying it 3 months ago. It looked like the bottom is in, but we retested that low in the summer. And these gold stocks have been consolidating for almost a year, and now it looks like with sentiment pretty bad, sentiment is going to turn bullish. People are probably going to start moving back into the gold stocks. It looks like we're probably going to test resistance. What are your thoughts on what's been happening here?
I really like what's happening, and I think my biggest reason for liking it is sentiment. The price action is nice with the successful retest, and now actually some gold stocks have kind of come out of the really short-term base. I mean, the base they've made in the last month or so. But what I really like is that because of the stuff going on in Europe, and I've seen a few articles again on calling for another Chinese blow up and all that sort of thing. It just seems to me that no one really believes it right now. Everyone is still out there looking for this big deflationary 2008 style bust. So even though you're seeing the gold stock slowly move up, you're seeing the euro firm up, the risk currencies, so-called risk currencies like the Australian dollar and the Canadian dollar moving again. No one really believes it. Everyone is sitting there scared on the sidelines and waiting for another blow up, either expecting the Europeans to not come out with a bailout plan or expecting the Chinese to blow up as well. That to me is really positive. That's like the real wall of worry. And I think what's going to end up happening is in 3 to 6 months' time, we're going to have another reflation trade here. Commodities go up, gold goes up, the gold stocks do well, and then everyone, there's going to be some problems in China because the dislocations that are there, but it's not going to be the doom and gloom total collapse scenario everyone's looking at. And then, then finally maybe people will rush into these things like they seem to do nearly every spring top.
Yeah, I mean, if you look at the S&P, very strong bottom there. I think it bottomed at 1070. Personally, my target was 1020. And, you look at a weekly chart, it's got a pretty firm bottom there. Also, what's kind of interesting to me is the DAX, the German composite. I mean, that over the past 2 or 3 months past 2 months, I should say, has a very nice bottoming formation. Looks very strong. It's already rallied about 20% off the bottom. So, looking at a lot of these charts, I don't see most markets going to new lows, at least any time soon in the next 3, 4, 5 months. So I think the deflation worries are, at least for the time being, are ending. And at the same time, the last time we talked about bonds, they've definitely come back. I mean, I think bonds definitely hit at least an intermediate term top. I mean, they were very overbought and sentiment was too bullish. So I think that supports what you're saying.
Yeah, if you look at, for example, I'll take another market. You look at India. The really nice base in the BSE, the Bombay Stock Exchange, from about 15,500 to about 17,000. And actually, we're just on the edge of making a short-term breakout. And the last little sell-off we got in a day or two in the U.S. didn't really spill over to India and some emerging markets. So I'm wondering if maybe they're starting some of the relative gains. And we talked about it because you're still in this consolidation of commodities. It's actually going to affect the emerging markets more positively. So they should begin to outperform here. I think that I agree with you that all these kind of like basing patterns and confirmations of bottoms are showing up, but everyone is still extremely bearish, psychologically. So that is really, really positive. Like some of the readings of things like the right asset ratio or some of the sentiment indicators aren't as bad as they were, but they haven't gone up to the point where you're going to see a significant top in the markets. They're actually just showing people are still wary, maybe not all out fear anymore, but that's really bullish because you're still going to see that wall of worry. And obviously one of the best sectors to look at in the short term is the precious metal sector because the stocks, again, got so cheap on this kind of sell-off, especially in the junior sector.
Yeah, I would agree with that. I saw a chart. I think it was Frank Holmes on Kitco who I don't know what data he was using, but basically they were saying that the exploration and development companies, basically all the non-producers, they were trading at 2008 type valuations. And then and also you look at the large cap stocks, the HUI or GDX, very strong base are going on for about a year. So if and when it does break to new highs, it seems like that, that's going to be an even more powerful breakout than we thought a couple months back. But one thing I want to talk about, which you mentioned the last time we did a podcast, was the energy stocks. And I mean, if you look at oil over the last couple years, I mean, it hasn't been anything spectacular, but this recent bottom, it held a long-term trend line. And if you look at the Amex Oil Index (XOI), you look at a 10 or 15 year chart of that. It has a strong bottom there in early 2009, a higher low in 2010, and we see the same thing again this year. So, I mean, looking at that kind of the strong bottoms we see over the past couple years, it makes me want to get more interested in energy stocks. So, I tip my hat to you for mentioning that. A couple weeks ago.
One thing people weren't pointing out with oil is the crude market is only part of the market. A big part of the oil market is the Brent North Sea. And because of all these problems in the Middle East, that's where a lot of crude is purchased from. So if you're buying your contract, a lot of people are paying this big premium from Brent North Sea, where you get at places like, the oil fields up in north of England and in Norway and places like that. And that's a lot more conservative source. So people are paying this premium because they don't know if, you buy oil from Libya or some other country, Saudi Arabia in the Middle East, you're going to get it right now because of all the turmoil. So that didn't really come off on this correction. It was just basically the crude that came off. And I think the fact that the Brent North Sea didn't really come off was a sign of, kind of strength going on in the energy markets,
Yeah, no, I think that's a great point. And, I mean, these energy stocks have really had a nice move. I mean, I'm looking at the XLE right now. It closed at 69 today. A couple weeks ago, you could have bought that at 55. So that's, I don't know if my math is right, but that's almost a 30% move just in the last couple weeks. So I wouldn't chase it here, but I just think if you have a long-term perspective, energy stocks are worth a look here, and of course precious metal stocks. Dave, we don't talk about companies a lot, but I know you're very familiar with Paramount Gold and Silver, which is a sponsor of the Daily Gold, and I just wanted to get your thoughts on Paramount for a couple reasons. First of all, looking at the long-term chart, it has a significant amount of support at $2. This is a symbol PZG. The stock came down over the last couple months. It's kind of been in a range from about $2 to $3. Now it's at $2.66. It looks like it's going to continue to move higher in the short term. Paramount had some really excellent news, I believe, on both of its properties in the last couple months. I don't know the market cap of the company off the top of my head, but I think it's only about 300 million or something like that, maybe a little bit more. And this is a company that has, I don't know it off the top of my head, but they have a significant amount of ounces in the ground. I mean, we're talking about 3, 4, 5 million ounces, something like that. They've had good news lately. We're starting to see that stock turn around. Yeah. Can you hear me?
Yeah. Actually, the market cap, by the way, is about 360 million. So no. If the thing about Paramount is, if you just want to look at the price in terms of, okay, last January the stock went to $3 to $4 a share. Now it's $2.60. But since then, they've had more good results from Mexico, their Mexican project there. The Nevada project, which was considered kind of an add-on project, anything that came from that was a bonus, now has a multi-million ounce deposit potentially. Yeah, so you look at the results that have come out, the only thing that's kept this back is the market. Like, this is a very cheap stock compared to the amount of ounces it has in the ground. I like the chart. I think you got this big consolidation going on between $2 to $3. And even, again, you look at Paramount, It went under $1 during the financial crisis, roared to $4 in January this year, and really is just seeing about a 6 to 9 month consolidation. So if you break out of that, there's no reason this can't go to $5, $6 a share. And that's based on the current amount of ounces they have in the ground, with the current silver price of 33 and gold price at over 1,700. So to me, this is one of the fundamentally cheapest stocks. And Jim Rogers has a nice saying that when you buy something, you should ask yourself, how much can it go down rather than how much can it go up? And when Paramount is getting down back to those low $2 towards $2 a share area, it becomes a very cheap stock. And you think to yourself, there's very limited downside with the amount of ounces they have in the ground.
Yeah, and I agree with you, Dave, and I just feel that, of course, I'm a little bit more tilted towards, the growing producers myself, and I feel those are going to do very well. But, I as you've been saying, I think there's a lot of companies like this that basically, if you look at their valuations, are very, very cheap. And, yeah, it may take a little bit of time for them to start to move, but I think Paramount is really a good example of that. Now, as we close here, Dave, anything else you want to touch on?
Not really, except for I think the next month or two is going to still be a great time to accumulate these stocks. And just so you know, Jordan and I aren't just like jumping on this bandwagon. Back in this, even though it was a little more sharp than we thought, we were calling for a pullback back in the summer. And then we have been calling for this kind of basing pattern to reoccur for the last month or two. So now I'm getting much more positive that we're going to be coming out of this phase, because I think one of the driving factors, and I hate to look for news to drive markets, but I think this will be the case, is, there's going to be some kind of solution, but probably a $1.5 roughly trillion backing of the European banks. And that is essentially going to set the currency markets to again start that trade where the dollar resumes this long-term downtrend. And that is obviously when the risk is on and when commodities can do really well. So that's kind of what I'm looking at here. And if you look at it this way, and this is another thing I think is going on behind the scenes, I think the Chinese are kind of, if you look at the Chinese, despite the fact that they own both bonds, they have talked a lot more negatively about the United States than they talk about Europe. So I think that the Chinese don't mind this trade where the dollar is weak and the euro strengthens for whatever reason. And George Soros has mentioned this the last few months, that every time that euro gets in the low 130s, there's a lot of buying that comes in, and it's probably coming from them. So I think that they look at things that the United States has not started any form of austerity, or at least Europe is on that path. And I think you're seeing assets move into the euro, which is why all these doomsayers are wrong, and it's not going to fall apart in the next few days. But why that's important to us is, again, you get that weak dollar trade, that higher commodities trade. The Chinese can really, the Chinese can really maybe drive this gold market higher, by kind of supporting the euro. And, and that can trickle down to our gold stocks.
Okay, Dave Skarica of AddictedToProfits.net. Dave, thanks so much for joining us today.
No problem. Thanks for having me.